Okay, 2012 A levels, question number 27. If the reserve requirement is 20%, so central bank has said keep 20% of your deposits as reserve. The existence of 100 million worth of excess reserves in the banking system, now it's a banking system, can lead to a maximum expansion of money supply equal to how much, guys? How do you do this when there is a banking system question? The banking system has excess reserves of 100 million. Okay, banking system has excess reserves of 100 million. Now they are asking you, because of this, now what can you do with this excess reserves? You can give those out as loans. So as a result, they are asking you, by how much can money supply increase by at the end of the whole trade creation process, the maximum expansion of money supply? How do you do this then? You can do this by using the deposit multiplier. How much is our deposit multiplier if our SRR is 20%? How do we calculate deposit multiplier? Deposit multiplier equals 1 over SRR. That is 1 over 0.2. 20%, don't write 20, okay? 20% means 0.2, no? So the deposit multiplier is how much? It's a 5 times. So then, guys, this 100 million, if it's given out as loans, what happens? It gets multiplied by 5 times, and at the end of the day, deposits will increase by how much? Deposits will increase by a 500 million. Remember, our money supply is what? Money supply is currency held by public plus demand deposits. So according to this question, currency held by public is not really changing. CC is constant. Because of this 100 million excess reserve, if it is given out as loans, it gets multiplied 5 times. These are credit creation, guys. Please go through that video if you all don't know. And then what happens? Demand deposits will increase by 500. So if demand deposits increase by 500, money supply will also increase by a 500. Okay. So answer number 4. How many of you all got that correct? Not a very hard question, a normal trade creation basic one. Banking system. Good. Then we'll go to 28. If the public desire to hold money as currency increases, what will be the impact on the banking system? Very interesting story, guys. Okay. Now, the people decided they don't want to keep money with them. They don't want to keep money in deposits. They want to keep the money with them. There was a similar question in the mock exam yesterday also, no? So, the public decided to keep more money with them. So, if the public's desire, right? If the public's desire to hold money, okay, to hold money increases, what will happen? Yes, if there's a banking system, we use the multiplier. What will happen? Now, what is happening? All the people are withdrawing their money. Whatever that is there in the banks, they are now withdrawing. They are keeping money with them. Or they are not depositing the money. They don't like to deposit. So what happens to the deposits and the reserves in commercial banks? Reserves in banks. What happens to this, guys? So people don't like to put their money into banks. So what they are doing, they are either withdrawing the money, or the money that they have, they are not putting. So what is happening? The deposits and reserves in commercial banks are coming down. Now, if the deposits and reserves in the commercial banks come down, what happens to the ability of commercial banks to give credit, or in other words, expand credit? What happens? Ability to give loans, ability to give out loans. What happens? Ability to give out loans will also come down, no? Because now commercial banks don't have money with them. People are withdrawing their money. People are not either putting their money, right? So they like to keep money with them. So therefore, ability to give out loans come down. If the ability to give out loans come down, guys, what can you tell about the money supply in the economy. Money supply in the economy can start to come down. Right. Now, so this is the basic story. Can you all, we'll go into the answer and see which one makes more sense. Answers. Number one, banks would be able to increase their liquid assets. Liquid assets means, guys, reserve. Okay, that is their liquid assets. So when people keep money with them, will the bank's reserves go up, their liquid assets? No, right? Wrong. Banks would be more able to increase their earning assets. That is like loans, earning assets, where they can earn an interest. Will that happen? If people are keeping the money with them and not depositing, banks can't give out loans, so their earning assets also will come down. Banks would be less able to reduce the interest rate they charge. That will keep it low. We don't know. Fourth one, banks would be able to expand credit. Can they give more and more loans now when the customers are keeping money with them? No, no. Then banks would be able to, will be less able to expand credit? Yes, no. When the customers keep money with them, now the banks don't have money to give out as loans. They are less able to expand credit, less able to expand credit. So this one can be your answer. What's the third one once again now? Banks would be less able to reduce the interest rate. Now think, guys, think about the reserves that banks have. Banks have very little money with them, no? Customers are not putting money in the bank now. So banks have very little money with them. What do you think will happen to the interest rates? Interest rates will be much higher, right? So this reducing interest rates and stuff, you can't 100% say that also, but usually interest rates can be high. So we'll go with answer number 5. Is that okay, Namai? 28, answer 5. Not hard. Then we'll go to 29. Guys, I made a small correction in the tute, right? There were some questions that were repeated, then, there was a small thing. I sent the newer PDF. I looked at the past paper and I corrected it. Okay. So question 29 is this. In the initial PDF that I sent, there was a small mistake. Okay. Suppose that the amount of reserves in the commercial banking system equals 100 billion. So there is a commercial banking system has reserves of 100 billion. Amount of deposits equals 800 billion. Amount of currency held by public equals 200 billion. Under these circumstances, money multiplier would be equal to. Yes. How do we calculate money multiplier? Money multiplier and deposit multiplier are two things. Okay. Deposit multiplier 1 divided by SRR. How do you calculate money multiplier? Money multiplier. How do you calculate this? Money multiplier, guys, is equal to your money supply, okay, MS, divided by your high powered money. Money supply divided by high powered money. Can you tell me what are the components of money supply? What and what do we have? Money supply is the addition. Usually when they say money supply, unless they are specifically told, it's M1. Okay. So what does M1 money supply have, Lamai? Currency held by public plus, I'll say CP, we'll say CCP, right? Currency held by public plus demand, deposits of public in commercial bank. Right. What does high-powered money have? High-powered money. What and what does it have? High-powered money has currency held by public, currency held by commercial banks, I'll say KB. Okay. Commercial bank, Combank deposits with central bank, right? That is the SRR component. And any, I don't have much space, so I'll put the next one also here. Any government agency deposits in the central bank. Those are the components of high-powered money. So if we can find this, we can find the money multiplier. We'll see. They have told us, now we are trying to calculate money supply and also the high-powered money. Suppose the reserves in the commercial banking system equals 100 billion. Reserves are what? Under high-powered money, currency held by commercial banks. So they have how much? 100 million there. Amount of deposits equals 800. Demand deposits are, that's a component of money supply. DD. Demand deposits are 8. Amount of currency held by public is 200. Currency held by public is there in money supply also. Currency held by public is there in high-powered money also. Okay. Anything else? Now see, in money supply, CC and DD we have, right? Fine. In high-powered money, currency held by public we have. Currency held by commercial banks, this reserves part we have. The others are not given. So we'll assume it's 0. Okay. The currency held by the banking system can be the excess reserve. Maybe can. Okay. So then total money supply that we have is 1,000. Total high-powered money that we have is 300. So can you work around and tell me how much is my money multiplier? Money multiplies money supply divided by high-powered money. Remember the equation at the beginning. So that is 1,000 divided by 300. So how much do we get? We get a 3.3. Answer number 5. Okay, not that hard. Is that okay, guys? Manageable? 2012. We'll go to the next one. Question number 30. An open market purchase of government securities. Same as a reverse repo. Okay. Open market purchase of government securities by the central bank will do what? Okay. We'll think. Now, central bank is purchasing. So, quickly tell me, guys, when the central bank purchases, who are the ones who sell? Who has to sell? Central bank is purchasing means commercial banks are selling. Okay. So if the commercial banks are selling, okay, if the com banks sell, what happens to the reserves in the commercial bank? Reserves of commercial banks. So in other words, currency held by commercial bank, which is also a part of high-powered money, the monetary base, right? The reserves increase. Okay. If the reserves increase, what happens to the amount of loans the banks can give? The loans the banks can give. Loans the banks can give will increase. If the loans the banks can give increase, what will happen to the money supply? Money supply will increase. What if we continue further? If the money supply increase, what will happen to aggregate demand? What will happen to aggregate demand? Aggregate demand increases. If the aggregate demand increases, what happens to the price level? Price level increases. So what is this? This is inflation. So remember, what is the central bank's ultimate objective with the monetary policy? To control inflation, no? So if they purchase treasury bonds, inflation will go up. If they sell treasury bills and bonds, inflation will go down. How it connects, you draw and figure it out. So think, guys, which one can be the right answer? According to this, increase in bank reserves. Is that part correct? Increase in bank reserves. When the central bank purchases, we said yes, bank reserves will go up. Thus, increase in monetary base. What is monetary base by? High-powered money. So, if the reserves increase, remember, currency held by commercial banks, that is their reserves, no? That is a component of monetary base, no? Component of high-powered money. So, don't you think that there will be an increase in the monetary base? Monetary base means high-powered money. Increases, no? So, that also looks correct. So, maybe one can be our answer. We'll look at the other answers. Decrease in bank reserves, wrong. Increase in bank reserves, okay, and a decrease in monetary base. No, no. Bank reserves will go up. Reserves is a part of the monetary base or high-powered money that will also go up. So, no. Then, currency held by commercial banks is usually their excess reserves. Okay. Decrease bank reserves, no. Decrease bank reserves. How does price level go up? This is demand pull inflation, right? Remember, demand pull inflation. When aggregate demand goes up, how the inflation goes up? Remember, in unit number 7, we learned, okay, aggregate demand, aggregate supply. This is the price level, this axis. So when the aggregate demand increases, what happens? The price level also increase. That is how the price level goes. Okay. Is that fine? 30, answer number 1. Any questions? Okay. Right. So that is it with 2012. How did you all do? 1, 2, 3, 4 questions. How much out of 4? 27, 28, 29, and 30. So reserves increase because commercial banks are getting money now. When the central bank purchases, commercial banks are selling. So commercial bank reserves means the amount of money commercial banks have with them. So when central bank is purchasing, central bank gives money to commercial banks. They have to, when purchasing, you have to pay money. So commercial banks get money. So commercial banks reserves go. Okay, right. So 2012 is done.